we get started with our presentation tonight, I'm going to run through a little bit of housekeeping while our final guests are joining us. I'd like to remind everyone that tonight's presentation is being recorded and that the information that you hear this evening is current as of today's date. In the future, if circumstances change, there is no obligation on Telarray's behalf to change the content that you are going to see tonight. Nothing here represents a recommendation or offer of any specific security or investment. Investing is a fundamentally uncertain process, and Telarray cannot predict the future or guarantee any specific investment results. If you have joined us before, you've seen me. My name is Chelsea Sloan. I am the Director of People Experience, and I'm joined this evening by Telarray's Chief Investment Officer, Jean Gard. We are pleased to announce that we are welcoming Eduardo Repetto of Avantis Funds. Avantis, excuse me, Eduardo. Avantis is one of our main fund providers, and we are so glad that you could join this discussion this evening. I want to remind everyone too, our guests, please feel free during this discussion, if there are any questions that come to mind, please feel free to use the chat box, and we always reserve a few minutes kind of towards the end of our discussion to make sure that we can answer every question that you have for us during our time. Thank you to everyone who is spending time with us this evening, and Jean and Eduardo, I will hand things over to you.
All right. Well, thank you so much, Chelsea. I'm just moving things around here a little bit. So yeah, again, thank you, Chelsea, and welcome to Eduardo. Again, the point of the discussion today is to try to give some more information about the sorts of funds we use here at Telarray and what's generally referred to as the factor-based approach to investing, and also to learn a little bit more about Eduardo. So let me spotlight Eduardo here. And yeah, again, really appreciate you joining. We don't have to read a bio for you or anything, because I think your reputation precedes you, and probably most of the people watching are familiar with you. So again, can't help thank you enough for taking your time to be here today.
It's a pleasure. It's always a pleasure. Thank you for inviting me.
Thank you. Thank you. We always like to start with a little bit of background on our guests. So I thought one of the things that's important we could talk about is the fatigue behavior of ductile face-centered cubic metals. Is that something
my goodness. That's my thesis.
So whenever we have somebody with a doctorate, it's always fun to go look at, you can always find their dissertations. And so Eduardo, as most of you probably know, received a PhD in aeronautical engineering from Caltech in 1998, right?
Yeah. So defense was 97, commencement was 98. Yeah. So yeah, and yeah, that's the title of my thesis. I didn't know that you were going to have it here. Probably if I have to read it, I will not remember much of the details. But I can speak. I can speak about that if you want.
So just one sentence. I couldn't. This is the first sentence I read when I was skimming it. It says, in an attempt to resolve the dislocation structures experimentally observed during cyclic loading, a theory based on the non-convexity of a pseudo-energy density is developed. That sounds really exciting. But one more little background thing. I didn't get much out of the actual document, but there was a very lovely poem in the front from El Gaucho Martin Fierro by Jose Hernandez. I just wondered if that was something that caught your attention, or if it's something that's meaningful for
you. Well, I'm from Argentina, so that's like the cowboys in Argentina, and also in the south of Brazil, some part of Paraguay and Uruguay, called gauchos. In Brazil, they call gauchos, in Argentina, gauchos. And so that is a whole book of poetry, but used in the language of the gaucho. And it's a famous book. So that's why I say, if I'm going to start the thesis, I'm going to start with the first part of that book. That is, I sit down here to start singing. And so I sit down here to start singing, and then I write all that thesis that is way more complicated than poetry. I think it is. Sometimes poetry can be complicated. Well, I didn't even remember, to be fair. Now that you tell me, I remember all these things. This is, how long? That's 25 years ago. Yeah.
Yeah,
no,
a long time ago.
yeah, 25 years ago. My goodness. Oh,
Yeah. Well, I don't know. Can we call you Gacho? That'll be maybe my nickname in the head from now on.
you can. That's okay. We can call many things.
Yeah. So we don't have to dwell too much on your early career, but I guess one general question is just what that transition from that very hard science aspect into finance. I mean, did you find finance more challenging or less challenging? Or, I mean, what did your aerospace colleagues think about you jumping into finance as you did?
To be fair, my thesis was in the aerospace where aeronautics department of Caltech in the engineering and applied science division. But my thesis was more on material science and materials modeling. So you can think about aeronautics and say, oh, you know a lot about planes. I know some, but I'm not an aerodynamics guy. I'm a materials guy, see if you want to think. And materials have a lot of weird properties. And, you want to understand those properties because if you understand them well, then you can create better things. You can use better use of those materials and create devices that you cannot create if you don't understand very well. Certain devices, certain materials have certain properties and you want to use them the best possible. And that this is about if you know how you cut a wire. You can cut a wire, you cut the pliers and cut it. But then if you bend it over and over and over and over many times, the wire gets cut. And that's called fatigue, metal fatigue. Well, this is about that, more or less. That's more complicated, but more about that. so yeah, I have a thesis in cutting wires. You will say, okay, that's fine. So when I before starting my grad school, I first say I'm a civil engineer from undergrad, then a mechanical engineer from Brown, and then aeronautical engineer from Caltech. But between undergrad and grad, I worked with a mathematician that he was at IBM. So he left science and went to finance. And he said, you will have fun in finance. So that always in my mind. And he's a good friend and he's a mentor. And all of us have a lot of mentors in life, and he's one of them for me. And so when I finish my PhD, you can decide, well, do I become a professor or do I do something else? And I thought it was a good idea to do something else. And so I said, let's go to finance. And I was lucky enough to get a good job and have good mentors in finance too. And there's many things that you learn when you're doing a PhD, that even though it's not about materials, it's not about scientific hard sciences, the toolkit that you learn on the math, on the computers, on the optimization, on the thinking in general, about the statistics, can be applied to social sciences like finance. And so you have the toolkit, you have to apply to a different set of things. And that's what happened with me. I was able to apply all that toolkit to working in finance. It's a steep learning curve, but you have the tools. And so it's not as tough as if you don't have the tools. And it's a different language also. The language, here we speak about ETF, mutual funds, derivatives, all these kind of bonds. When you're speaking about materials, you don't speak about this thing, you have a different language, but you have the language, you can adapt very, very fast. And so I was lucky enough to do that. I'm not the first guy from science. I told you about my previous boss and also mentor, Luis Reina. He moved to mathematics. The high-end mathematician went to work in Wall Street. But there are many cases like that. I think at the Bob Merton, for example, got a Nobel Prize in finance. I think that in economics, he studied mechanical engineering. At least he started the mechanical engineering. So it's common, You can use the numbers to work in finance, and that's what we do. Yeah.
Well, I think we all feel very fortunate that you made the jump from materials engineering to finance. And so, I think the early part of your career is very distinguished and I think pretty well documented. But I mean, what's interesting is, as most people on the call know, Avantis is one of the cornerstones of our portfolios here at Telarray. And we just came on the 3-year anniversary of the founding of Avantis funds, right? So, yeah. I mean, is it, I'm curious if you feel like the first 3 years have met your expectations or exceeded your expectations, or do you wish that you could have done more? I can't imagine how you could have done much more, but interested in your
But
thoughts.
it have been very interesting, and yes, it have been exceeded my expectation. I'm always happy, so that's not the problem. But think about that. We launched Avantis in September 2019, basically. Yeah.
Mhm.
Let's imagine I tell you, Gene, we're going to launch a company. You're going to have a pandemic that is going to shut down everything. Markets are going to go down like 50%. And then you're going to have another, a couple of years later, you're going to have another one that the market is suffering for year to date. Markets are not being the nicest markets. And these are going to be part of your first 3 years. So, will you do that? I'm probably, no, I'm going to do something else. But you never know. So it has been, despite all this, it has been good 3 years and a half. We were able to grow from nothing to more than $18 billion under management. So today, this is the December 13, we crossed $10 billion in inflows across our mutual funds, ETFs, as separate accounts. So, and we're very thankful. We don't take this lightly, because our job is to help you, Gene, and your team help your clients.
Right.
We want to do the best job we can. We want to apply the latest in financial science, the latest in technology that we can apply in order to try to deliver the best investment solutions that will help your clients hopefully achieve their goals. And so we don't take it lightly. If we do that right, the growth and all these things happen, but we need to be very, very focused on the service that we provide and try to do the best we can.
Yeah. Well, thank you. Well, let's change the focus a little bit. I mean, I could talk about you and Avantis all day, but let's actually talk about what Avantis is doing for the shareholders and our clients. And so I guess the first thing I'd ask you to do, and I do this in different ways, being on the investment team here, but it's sometimes challenging to even convey exactly what's going on under the hood in funds like yours, because a typical person might actually be somewhat familiar with financial markets. They might say, well, I understand index investing, I understand index funds, I understand an active manager who picks stocks, but what exactly is, so if your elevator pitch, we'd love to hear that. And you can go more than 15 seconds, you can go for a couple minutes.
Oh, we this is like peeling an onion. So let's do first 15 seconds.
Sure.
I said, Gene, you can buy a company that has good cash flows and a decent balance sheet at low price, or you can buy a different company that has similar cash flows, similar balance sheet at a high price. Which one will you prefer, Gene, to pay for the same?
I like the low price for sure.
Okay, you like the low price. And basically, you're buying, if you buy something at a low price, you are expected to get higher appreciation, higher expected returns, higher expected performance. Right. So in one word, that's basically what we do. We're trying to look across all the companies in the US market, international markets, or emerging market, depending on the portfolio that we're managing. And we're trying to find what companies are trading at a low price relative to those fundamentals, the balance sheet of the company, the equity that the company has, and the cash flows that the company has. Because if we buy something that has low price relative to those fundamentals, the expectation is that that's going to do better over time. And some companies trade at a very high price relative to fundamentals. People get in love with those companies and push prices up and up and up. Well, those companies tend to have lower expected return, lower expected performance. So we try to develop a discipline in order to have at all time a portfolio that focuses on companies that are attractive from the pricing point of view, so expected returns are higher. Yeah. That's basically, we can get more and more complicated and put numbers and whatnot, but that's basically what we do.
And I think what's interesting is a lot of people don't understand this, but when you talk about, generally speaking, cheaper companies, generally what you're referring to is what we would call the value factor, right? Which I think people hear value and growth and they think, well, value sounds good, but I want growth in my portfolio too. But really, value just means cheap and growth means expensive in this value factor. So that's one factor, but can you talk about some other factors that Avantis pursues within the portfolio?
Yeah, so we have a broader definition of what is value. So in general, the typical value definition, you buy company have cheap companies, so company have low price relative to the equity that the company has. So in our lingo, it's called the book value. So if you think about the balance sheet, the company has assets and liabilities. The difference between the assets and the liability is the equity. So in general, people define value as low price related to the equity that the company has. But that's an incomplete story, because you can have two companies that have the same amount of equity and the same price, but one has much, much higher expected cash flows, much, much higher profits than the other. And they are very different from the point of view, because you tell me you're paying the same price for a company that has higher profits than a company that has lower profit. I know which one I will pick, the one with higher profits. And so, so our definition on value incorporates the balance sheet, so the price to equity, price to book, and also the profitability that the company has. So we really think that companies have reasonable high profitability and low price relative to the equity that's necessary to generate those profits. Those companies are priced attractively from the point of view of expected return, future performance. And that's what we call value. And it's true, people should have a little bit of everything in the portfolio, a little bit of growth, a little bit of value. But these companies that are priced attractively tend to have higher performance. So in general, you get many advisors saying, I'm going to have a little bit of every company to get enough diversification, but I'm going to overweight the ones that are expected to perform better, so I have better outcomes from my clients. And that's very common. And what we try to do is try to have the best ways to identify those companies with better expected outcomes.
Yeah, that's great. And you've talked about diversification a couple of times, which is something that, of course, we like many firms like ours are very insistent upon. And one thing that's become popular is there's some books out there that are sort of popular finance books that suggest you can just own, say, the S&P 500 index, and that's sort of your fire and forget, one shot fixes all. Or even total market funds, or I mean, these days it's waned a little bit, but for a while people were having some really wild strategies to buy as many, I bonds from the Treasury as possible, even though their real return is zero. So just could you just, we just love to get your take on diversification and how you think about that. And a particular part of that is international diversification, which has been unpopular. It's been something that we've insisted on, and it's nice to see that that's paying off this quarter extensively right now. So
it's a great question, and I'm going to answer that with history. So there is someone called Harry Markowitz, very famous professor, that back in the early 50s start thinking about mathematically or theoretically how people make investment decisions. And if we think that people only should be making investment decisions by maximizing returns, and I give you a list of 10,000 securities, if you only care about maximizing returns, you're going to buy only one name, one security of the 10,000. Which one? The one that has higher expected returns. That's it. That maximizes your expected returns. But Harry Markowitz realized that's not what people really do. So they must not be maximizing returns, just maximizing returns. They must be managing their risk also, because when we're saying that company has the highest expected returns, that's what we think, but we really don't know. There is uncertainty. Maybe that's not the one that we hired. The number 10 in the list is the one we hired. And so there is, given the uncertainty, you have to manage that risk. And the only way to manage risk is diversification, not put all your eggs in one basket. So Harry Markowitz developed this idea that there is a trade-off, a balance between expected returns and risk that you take. And so that's where the concept of diversification in modern finance, even though there's some idea that happened hundreds of years ago in other contexts, but in modern finance, that's when it started taking place, and all modern finance basically hangs from there. And so diversification is super, super important because it allows you to manage the risk, to manage the uncertainty, and you cannot bet all your wealth in one egg. You want the basket, and it's the same story here. And
yeah. I mean, one thing we tell people is that expected return is sort of like a weather forecast. You know, if it's a 90% chance of rain, it's likely it'll rain, but it might not. Just in the same way that expected return doesn't always turn into realized return.
And that's true. And so if you think about diversification, if you think from the negative point of view, it's not good because you're never the best.
Right.
Also, it's good. You're never the worst. You never lose everything if you are well diversified. And so diversification is trying just to be about the water, dealing with the waves, and having enough footprint that you are afloat, you don't sink. And so diversification is extremely important, and mathematically you can prove it. Psychologically you also prove it. You can sleep better, you can have better portfolios, and hopefully over time you have better growth in your wealth.
Yeah.
And international, you mentioned about international. Well, that's what I said. International. Look, if all of us knew that international stocks are going to underperform, what will we do? Sell them and not buying them again. What happens the moment that we sell them? The price goes down dramatically. At some price, they become attractive, you know. Right. And so that's what the market is doing. So when we see that the US does better than international, a lot of that is unexpected, random performance, that news came and this is better than the other and whatnot. Like, for example, if you think about international markets underperforming the US over the last several years, well, part is that the stocks in the US did better than international stock, but part is also that the US dollar became much, much stronger. So if the US dollar becomes stronger, foreign companies' returns suffer, and so that's part of what happened. But a lot of these things are unexpected, and that by being, and it can flip around, it can be exactly the opposite, and it has happened in, like, for example, from early 2000s to 2007, international did much better than the US. And so by being diversified, you just cut a little bit of the noise and try to be a more balanced performance. You have a more balanced performance, and so it's important.
And that actually reminds me of a question. Recently, Avantis, we actually don't typically use funds like this because we have more of a component-based approach, but I believe you launched sort of a global single equity fund. So I'm curious how you went about thinking how to allocate international versus domestic versus emerging and all that sort of stuff. Was it just based on natural weights, or?
That's a great question. So let's think about the global market portfolio. So what is the global portfolio? You get the equity securities, Apple, Microsoft in the US, and all the rest of the US, but also you get British Petroleum, and you get Alibaba, all the equity securities all around the world. Mm-hmm. And if you see what's the weight in the market capitalization, the natural weight of those securities in each one of the markets, you're going to see that the US today is around 61% of the world. Non-US, so international developed and emerging markets, non-US is around 39% of the world. So you can say, well, let's buy a global portfolio that is going to be more or less 60-40 US and international. And that's a good portfolio. If you think theoretically, that's probably one of the most diversified portfolios because you're not really making a bet, you're buying like the weights in the market. Mm-hmm. Well, that's true, but if you're investing in international stocks, you have higher costs, higher expense ratios, or higher costs than if you buy US stocks. So, and the same for foreigners. If you are an Australian, it's less expensive for you to buy Australian stock than buying foreign stocks, American stocks. So given that it's more expensive for us to buy international than domestic, you tend to have what is called a home bias. You overweight a little bit the US.
Yeah.
And so, yes, we launched a global equity strategy, and our allocation to the US is around 70% instead of 60% that is the natural way the US today in the world portfolio in the global market. So we are having a home bias. We're overweighting a little bit the US. I still have an international because we lack the diversification benefits of international stocks.
Yeah, that's great. Yeah, thank you. That's very helpful. Changing gears a little bit, you know, Avantis is obviously a major player in, you know, people who take this academic research and apply it to the financial markets. And there's other practitioners out there, some of which, you know, we use in our funds here at Telarray. So I'm just curious on your comments, just in general, if you had to define how Avantis looks at the world differently, even than those other people that are on sort of a similar path, and what sort of makes Avantis unique, or if there's any major sort of theoretical differences there.
Yeah, that's a great question. So the first thing, let's start speaking about implementation. So if you were speaking at the very beginning, there are people that pick stocks, you know, they speak with the CEO, the CFO, say this is a good company. I pick 30 of these companies. That's a stock picking. We are not that. That's taking too much risks, and we don't like that. We are more on the systematic way of investing. And if you think about on the more systematic way of investing, you can have what is very popular, index funds. And what is index funds? It's basically one day of the year, Russell, for example, decide these are going to be my holdings for the next year. So you buy these securities, and then you hold them for one full year. So if the price goes up, the price goes down, doesn't matter. You hold those securities, make no changes for a year. That we think that implementation is a little bit of brute force, because not reacting and changing in prices, not reacting and changes in fundamentals, so the company financials and whatnot, is for a full year, it's a little bit extreme. It's like Eugene deciding today you're closed for the whole year. In summer, you're going to be a little bit hot, I guess. So we think that a good investment process should be broadly diversified, but should consider current events, should consider the price changes when they change, because every security change prices at different times, or fundamental changes, new company financials. So our approach is as diversified as an index, but it's considering changes in prices as they're happening and changes in fundamentals as they're happening, instead of deciding I'm going to hold this security artificially for 12 months, 6 months, or what's the period that they define. So that's how we're different with an index. Now, there are other people that are similar to us, not many. Now you're getting narrower and narrower set of managers. And so if you get to the managers that also are systematic, that they want to have the same benefit that an index has, that is tax efficiency, low turnover, low fees, broad diversification. Well, if I want to have value added, higher expected returns, I need to consider prices on a daily basis, because you know, if it's a good deal or not a good deal, depends the price you pay for the security. And so in that subset, now there are less managers. And so probably you have a handful or 2 handfuls of managers. Well, each one of us is going to be a little bit different than others. In our view, we are very good. Why? Because we incorporate the latest in financial science. And so we use a complete valuation method using balance sheet, statement of cash flows, income statement to earn with price in order to develop portfolios that have higher expected returns. And we focus on today's prices, today's financials, in order to just being able to sell a security and buy another security, because one may have been attractive yesterday from the point of view of price, but not today. So we do all that monitoring on a daily basis in order to enhance expected returns. And people have liked it. Remember, we started from no assets under management 3.5 years ago, and we have more than 18 billion today. So people have liked, and we tend to have very reasonable fees. Our fees tend to be low among all the people that do what I say, tend to be among the lowest, if not the lowest. Index funds in many cases are less expensive, in other cases are more expensive, but in some you can find index funds that are less expensive, but they're really not monitoring their portfolio on a daily basis.
Yeah, well, that's very helpful. Yeah, that's interesting. So another question we had is just to get to a more of a sense. It seems like there's been a steady stream of new funds coming out of the Avantis complex. It seems, would you say that it's really based on client demand, or do you have a master plan to sort of fill out a roster eventually, or how do you think about when to bring a new fund to market? And how big does a fund have to get to be sustainable? Is there any sort of target you have, or how do you think about that?
This is a question. So we do have a master plan, yeah. But so we have been working in the industry for a long time, and so my master plan is to provide tools that can help you help your clients. And we know that you will need a large value portfolio. We know that we will need a small value portfolio. We know that you may need a microcap portfolio. We know that we need some fixed income portfolios. And so we know more or less what investors need. So our job is to develop products that are better than anyone in the competition, that can replace whatever you're using and make your clients better off. And hopefully we can do it at lower price. So not only they're better off from the investment point of view, but also they're better off from the expense ratio point of view, how much they pay for those portfolios. And so that's our master plan. So which product, which one of these investments or strategy or ETF or mutual fund come first to the market? That's a little bit more random, because if I know that I'm going to have next year 7 new strategies in the market, but Eugene comes and say, I really need this before the others, and we have been working together for a long time, or a consultant comes, I really need this for a 401k plan. So then we say, well, let's put this first in the queue, not last in the queue. And we go with this first and not the others. So that's how we've been launching products. So we launched 5 initial strategies on day 1. And then people say, oh, you have that. What about this? What about that? What about that? As long as it's something that we have in the master plan, we just go and do this before the other one, and we can provide a service. Remember, we are a service company. We are here to serve our clients. We are here to help you serve your clients. And so if there is something that you need, or any other advisor, and you know, we try to put it in front of the queue and not in the back of the queue. You know, at some point we get to the queue, but you know, some people, some of these strategies may need to come earlier than others.
Yeah.
And you want to be sure that no one likes launching a fund or an ETF that doesn't grow, because that means that you are not really servicing anyone. No, remember, I want to provide a service. That means that I have to create something that is needed. If it's not needed, it's not going to grow. And so we always work together with investors trying to develop things that are really needed.
Yeah, that's great. One thing as part of that, you know, here at Telarray, we primarily implement our sort of flagship model portfolios in mutual fund structures. And the main reason for that is because that's just what existed. You know, the types of strategies we wanted access to were mutual funds. But now I think what we're seeing, and something that's on our strategic plan locally looking forward, is to consider beginning to transition into more ETFs, or potentially even in our flagship offerings, focusing on ETFs, or at least starting to buy ETFs for our existing clients on the margin. So, I mean, long term, I mean, I've talked to other people at Avantis that feel, I mean, I've had very experienced people that work with you say that they would prefer ETFs and don't really see a role for mutual funds long term. I mean, how do you feel on that? I mean, 10 years from now, 20 years from now, is it going to be ETFs, or are there going to still be mutual funds out there?
That's a little bit of a strong statement. So ETF, in many cases, have a real advantage related to mutual funds. But in some cases, you just cannot use ETF. You have to use mutual funds. Like, for example, if you have a 401k plan, the plan itself cannot really have ETF, at least today, not because of any issue that operationally doesn't work, to get things to work. Like you have an amazing car. Let's suppose that you have an amazing car, but if there are no roads, you cannot drive it. So the same is a 401k. So there is a lot of infrastructure for when the HR department decides to make a contribution until that contribution gets invested. And all that infrastructure, think about the roads where the money has to go. Well, all that infrastructure in 401k plans has been developed for funds, not for ETFs. So operationally, in the 401k market, funds probably will stay here for a long, long time. I don't foresee them going. Yeah. On the wealth management side, if you go back to in the year 2000, ETF were not big. They were around less than 100 billion, I think. But today, they're like $5 trillion. They're growing and growing and growing. Why? They're growing and growing and growing because they provide a better service than mutual funds to investors. And that's accelerating. So, it's that is like a hockey stick. It's accelerating that because more products, more investment solutions, more competitive fees, better markets, custodians not charging ticker charges so transaction charges when you buy or sell an ETF, but yes, when you buy or sell a mutual fund. So a lot of things, all the ecosystem for ETF is developing in a way that is more competitive than the ecosystem for mutual funds. So I imagine that a lot, and you see that, a lot of money is moving away from funds towards ETF, and ETF are becoming, the main investment solution. But as you say, if you go 10 years ago, that's the jury was still out, if you want to think about that. And now the jury probably it's not out, has come and you see the transition. And so what you are doing is basically what many other people are doing. They were they were very good fiduciaries thinking about what is a reasonable investment today, mutual fund. But over time, probably you will move into ETF, like you're saying, because that's what's happening. Think about pay phones and Apple phones. You were, when the cell phones were that big brick with antenna, you were using pay phones. But that's today, right, you don't use pay phones. So technology brings transition from old technology to new technology. This is the same that you're seeing here.
Yeah. And to be clear, we have material, we don't want to dwell on it on this conversation, but we have material about the differences. And actually, there are some distinct advantages to mutual funds. And again, really the reason that we're primarily mutual fund here is because these strategies just weren't available. Yeah. But I think Avantis sort of led the way on introducing ETFs. And I feel like we're probably getting very close to the point we could essentially replicate our portfolios in virtually 100% ETF kind of expression. So it's definitely something on the horizon for us to look at going forward.
Love it.
So yeah, so I know we want to save some time for questions. I think maybe a couple questions came in, but the last kind of big picture question I had is just if you could comment on what's on the horizon. I mean, I think, probably the last, at least the kind of thing that gets pressed, the last sort of factor that was quote unquote discovered in the last 10 years or so was profitability. That's really come to the forefront. But I'm just curious if there's other, is Avantis doing original research behind the scenes, or is it more of a synthesis and an implementation sort of vector that y'all are on to accomplish, and innovate going forward?
Look, you have always start thinking and doing research, and also listening to the research of academics and of others. You cannot think that you're going to discover everything. You have to be open-minded about what others are doing. And remember, when I was doing my PhD, my contribution to science was this, built on top of whole set of other people that have done a lot of work before. So here it's the same. You do your contributions to research, but you have to be aware of everything that is going around, because you really want to be at the cutting edge in order to provide better portfolios. And that's at the factor or the variables that you use to identify security, but also at the implementation, because you can have a great idea how to pick securities, let's say, but your implementation is horrible. That's not going to work well for the client. So you want to think the implementation together with the risk fundamental research on how to select securities and what matters when you are selecting securities and when you are weighting securities in the portfolio. So yeah, we are pushing trying to push the boundary on both sides in order to be as good as we can. And so what's going on? Look, a lot of things are going on, but a lot of the research never goes anywhere. If it's as easy as discovering what is going to be, the amazing thing for tomorrow, it will not happen tomorrow. It will happen today and the day after and the day after and after. So things take time. Things are difficult, and many times you can have great ideas, but numbers say they really don't work and don't work. So that's part of research. So what we do is we are on top of everything that everyone is doing. We're doing our own things. And whenever there is something that is interesting to implement, can provide some value added, we do it. And sometimes it's a strategy, like we develop a strategy that focuses on inflation. Most people, when they focus on inflation, think about tips, treasury inflation protecting securities. They tend to have low returns, and other people who go and buy commodities strategies, but they have high volatility, have low returns. They're not very tax efficient. They're very bad in the taxation. So they say, can we develop something that is better, investing in equities in order to try to get an equity premium? And we did a strategy like that. So you always try to see, how can I provide a better service? Because the best service that, if I provide the best service around, your clients are better off, you're better off, institutions are better off, the consultants are better off, and if everyone is better off, we will do well.
Yeah, no, that's great. I do have one selfish question. That's for, I mean, it could be for anybody's benefit, but on one hand, I'm a reasonably credentialed investment professional, but when it comes to hardcore, cutting edge finance research in academic journals, I'm very much almost a layperson as far as interpreting that kind of stuff. Is there anything you could direct somebody who's interested in actually learning more of the nuts and bolts of what's going on behind the scenes with this style of investing? Is there a particular journal that might appeal to a more general audience, or a website, or is there any way for someone like me to keep up with that kind of stuff more effectively?
We have some material in our website, and everyone is more than welcome to go there, or you may have to go there. We have some papers there that are very easy to read. And some webinars. Then I did a webinars with a group called the Rational Reminders. It's a group out of Canada that do interview to many people. I just did a webinar with them. It's long. It's like 1 hour and 20 minutes. So man, you have to get your tea and biscuits and be ready to be there for a long time. But
yeah,
they have a lot of information in a way that is easy to understand. And you can always, if you want hardcore papers and you don't want to buy the journals, you can go to ssrn.com, where you can have hardcore papers on any topic of social science, including finance, by top academics. So that's another place that is worth. But that's.
Would you look to the most downloaded ones, or are there other criteria that help you find papers that might be of interest?
It depends on what topic you are looking. So you have to search by topic. So if I'm interested in something on real estate, or I'm interested in something on trading, or I'm interested in something on whatever, so you look for topic, and then for topic, you can look at the most downloaded. Though some people play games with that, so they have very high numbers, but you can look at well-known authors, and the well-known authors have good papers, and then you get the paper by the well-known authors and look at who are they citing, because every paper cites other important words, and then you start looking at other ones, and so you can create a tree of all the things that are relevant to you depending on the citations of the important papers, and then you have a holistic view of the topic that you are looking for.
Gotcha. Well, that's very helpful. Thank you. I think that's great advice. I think I'm going to turn it back over to Chelsea here. Let me give Chelsea the spotlight. I think we had a couple of questions come in, maybe. Could you?
We did. If you don't mind, Eduardo, one of our questions is, how meaningful is the outperformance expected in the long run of your type of approach?
Well, so the question is, let's suppose that picking securities in this particular way produce an outperformance. So what we are giving you is a ranking of what securities are best and worst, and then we select a certain security in order to be diversified among those securities. The performance can be significant. What we call is a premium is the difference between the performance of the portfolio that buys the good securities and the bad securities. The difference in performance between the good and the bad, let's say. And in some cases, the difference can be 9% in a year on average, depending on what you're looking. So there is a big gap. Now, by no means, I'm telling you, you should only buy these securities, because remember, diversification is important. That's why Gene and the team create portfolios that buy a little bit of everything, but overweight some securities related to others in order to produce some outperformance, but at the same time, control risk. So yeah, you can create significant outperformance, but diversification should be taken into account.
Thanks so much. I believe we have time for one more question. How long can factors underperform? How will we know if something fundamental has shifted in the markets?
That's a great question. I love that question. And this is important. And that goes to what is a factor. So if you look at academic, remember the academic papers I was saying, there is a paper that says there are 400 factors. It's called the factor zoo. So you go to the zoo, see all the animals. Well, this paper enumerates 400 different factors. And some of them are just empirically observed. There is no reason for them to exist, but they happen to happen in the past. Imagine you're going to the zoo and you see an animal with stripes and it says zebra. And then you say, well, every animal with a stripe is a zebra. That's an empirical observation. There is no theory that says all stripes are only for zebras. It's an empirical observation. So we know that you can be a tiger. It doesn't need to be a zebra if you have a stripe. So empirical factors that are based just on empirical observation, they're really not reliable. You want to have some theory why they are there. And that's why when we do what we do, we have a theory, valuation theory. It is because of valuation that the premiums exist. And then you corroborate that with empirical data, historical data in the US, in international and emerging markets, to say the empirical data fits the theoretical model. And so you know that it's not just data that happens randomly. There is a reason why that happens and a reason for that to persist. So if you have a factor or a premium that you think that it will persist, there is a reason why and everything. So say, okay, I check the box. This should outperform over longer periods of time. Will it outperform over the last 10 seconds? Well, the answer probably is 50-50. You outperform or underperform. Okay. What about the next year? Well, now probably it's not 50-50, but if 55-45. Well, I say, what about the next 3 years? Well, now you're speaking maybe 70-30 that you will outperform. So there is no predefined period of time that you say you will outperform, but the longer period, the higher and the higher odds that you outperform. And that's what you want. You want to tilt the odds towards you. The more that you tilt the odds towards you, the probabilities towards you winning, the better you are. And so if you have a reliable framework to identify securities based on valuations and empirical data, and you have a good implementation, you are tilting the odds towards you. very, very much. And the longer time period, the better the probabilities that you will do better and better.
It seems like that eventually, really the only risk to a factor, like a well-founded factor not working in the future, is if it just became so popular that there was so much interest that it was sort of overwhelmed. But I think this style of investing is probably selective enough at this point, and probably for the indefinitely, that that's very unlikely.
So remember the way you were speaking about growth?
Mm-hmm.
Yeah. Growth and momentum are factors or premiums that suffer exactly what you said. If they become very crowded, they are self-feeding. So I'm going to buy this. Yeah, this is a phone. I'm going to buy this. And you also want to buy this, and you want to buy that, and you want to buy the same thing. All of us are buying the same house, or all of us are buying the same house, and you get into a bidding war, and the price becomes higher and higher and higher.
Yeah.
But there is no mechanism to sell that security and buy a new one, because a growth strategy is buying high price securities. The more that we push the price, the higher it is, the more we want it.
It's
because
a positive feedback loop.
It's
Which
a positive
in engineering,
feedback.
a positive feedback loop is not a good thing.
It's the same as momentum. It's a positive feedback. If you are thinking about the kind of strategies or securities we select, look, remember what I said. I like to buy companies have a low price relative to fundamentals, the balance sheet and the cash flows. If the price goes up, they are not as attractive as the price is low. So if I buy a security that have low price and everyone crowds and buys the price goes up. What will we do? At some point, I will sell that security and buy a new one, because I'm always looking for security at attractive price. And so that helps quite a lot with the overcrowding. But some strategies suffer from that overcrowding. The positive feedback loop strategies suffer from that. That's not us, because we are based on valuations.
Gotcha. Well, that's really interesting. Chelsea, any other questions come in?
We do not have any other open questions at this time.
Well, great. Well, some of the feedback we've gotten in the past is that we talk too fast and rush things a little bit too much. So I think it's perfectly fine to go ahead and close things out here in a relaxed fashion, 8 minutes early. But I can't thank you enough, Eduardo, for joining us. Obviously, you have a lot of demands on your time. And I think we relatively early came on board with Avantis in your history, which is just past 3 years. And just as we diversify, across different types of funds and internationally and all that sort of stuff, we also like to diversify across providers. So I think we are very fortunate to have been an early adopter of Avantis, and I think we and our clients have very much appreciated what your firm has been able to do for us and the path to our long-term financial success for our clients. So thank you again. And is there anything we didn't ask we should have, or anything you like to mention?
No, thank you very much. Look, it means a lot. Remember, we want your clients to succeed. We want you to succeed. We don't know your clients, we don't know their goal, but you are the person that knows a lot about them, and so you selecting us to help you with your clients, for us it's a great privilege, and we take it very, very seriously. And thank you for doing that. And please let us know if we can do something better, or if you find any feedback. We're always welcome to hear from you, on anyone in your team, how we can do a better job. So please, thank you again, and it's a pleasure for me to speak with both of you.
Great, thank you. I think this will be a great resource that hopefully we can get it approved through compliance and make this available in the future as well for people interested in learning more about our style of investing and Avantis in particular. So thank you very much, Eduardo. We appreciate it.
A pleasure, guys. Thank you very much.
Okay, have a great night.
Thank you.
Bye. Bye.